There's probably a 1099 sitting in your mailbox right now, and you have no clue how it will affect your taxes. Add in that bonus that pushed you into a higher tax bracket, and the parent care costs you didn't document, and you've now got 3 things that can cost you extra in taxes for 2025. But here's the thing, you've got 10 weeks to fix all 3, and I'm going to show you exactly how. Most people think their 2025 taxes are already locked in. They're not. You have 10 weeks before April 15th to fix these 3 mistakes that are costing you thousands right now. Let's get straight to it. Here's mistake number 1. And it's the one that hits hard if you got a year-end bonus. You certainly earned it. You deserved it. But that bonus just pushed your 2025 income higher than you had planned and triggered a cascade of tax consequences you probably didn't see coming. Because this is how it plays out. Let's just say you're married, you file jointly. Your combined income is normally around, say, $350,000 for the year. You're in the 24% tax bracket. Then, your December bonus hits, $40,000. Suddenly, your 2025 income is $390,000 and you've crossed into the 32% tax bracket. That's an 8% jump. And on that $40,000 bonus alone, you're paying an extra $3,200 in federal taxes. But wait, it gets worse. Because you're closer to the threshold for the 3.8% net investment income tax, which kicks in at $250,000 for married couples. If you have investment income, dividends, capital gains, you're now paying an additional 3.8% on those. And if you're helping a child with college expenses, that higher income just reduced your financial aid eligibility for the 26-27 school year. 1 bonus, 3 tax consequences. And sadly, most people don't see these until they're sitting with their CPA in March. But here's the good news. You can still do something about it. You have until April 15th to make your 2025 retirement contributions. But which strategy you use depends upon your income. If you're under the phase-out limits, you can make a deductible traditional IRA contribution. For 2025, that's $7,000 for those under 50 and $8,000 for those older than 50. Every dollar you contribute reduces your taxable income dollar for dollar. Now here's where income matters. If you're single and covered by a 401k at work, the deduction begins to phase out between $77,000 and $87,000. If you're married, file jointly, and covered by a plan, it phases out between $123,000 and $143,000. So, for a $390,000 example, you're fully phased out of a deductible traditional IRA, but that doesn't mean you're out of options. If you're over the income limits, potentially you could move to a backdoor Roth. You make a non-deductible IRA contribution, same $7,000 or $8,000, then immediately convert it into a Roth IRA. No deduction this year, but now that money grows tax-free forever. And if you're married, you can do this for your spouse. That's $16,000 moved out of the IRS's reach permanently. Just remember, you've got until April 15th to make the contribution and execute the conversion for 2025. Now, if you're self-employed or you have a side business, you've got a third option, and that's a SEP IRA. For 2025, you can contribute up to 25% of your net self-employment income with a maximum of $69,000. Here's the key difference. If you file for an extension, you have until October 15th of 2026 to make your 2025 contribution. That's an extra 6 months compared to a traditional Roth IRA. So if you still got a $40,000 bonus late in 2025, here's your decision tree. Under the income limits and covered by a 401k, traditional IRA, full deduction, April 15th deadline. Over that limit, potential backdoor Roth, no current deduction, but tax-free growth, April 15th deadline. Self-employed with significant income, SEP IRA, massive contribution limits, October 15th deadline if you file an extension. The key here, folks, is speed. You have 10 weeks to execute these strategies. Because after April 15th or October 15th for your SEP IRAs, the window closes for 2025. So if you got a bonus late in 2025, Figure out which path applies to you and get that money moving before it's too late. Hey, I know this is a lot to track. Traditional IRAs, backdoor Roth, SEP IRAs, phase out, deadlines and limits. And the bonus timing trap is just one of the 3 mistakes I'm covering today. So I pulled together a checklist that walks you through every document you need to collect before you file your 2025 taxes. It covers income sources, deduction, documentation, everything I'm talking about in this video. It's the same checklist I use with my clients every year at this time to make sure nothing gets missed. You can go ahead and grab it for free using the link in the description below. It'll save you hours scrambling in March. Okay, let's move on to the second mistake I see constantly with sandwich generation families, and it's costing you thousands in deductions you're entitled to, but simply not claiming. You're paying for your parents' care. Maybe it's a home health aid. Maybe it's assisted living. Maybe you're just covering their prescriptions and medical bills because their fixed income doesn't stretch far enough. You're doing the right thing, but you're not treating it like the tax deduction it actually is. Here's the rule that most people miss. If you provide more than 50% of your parents' financial support in 2025, and their gross income is less than $5,000, you may be able to claim them as a dependent. Now, the gross income threshold is critical. Social Security doesn't count towards the $5,000 limit, but pension income, investment income, and withdrawals from retirement accounts do so. If your mom has $6,000 in pension income, you can't claim her as a dependent, even if you paid for everything. But if she's under the $5,000 threshold and you provide more than half of her support, their medical expenses count towards your medical expense deduction. Now, medical expenses are only deductible if they exceed 7.5% of your adjusted gross income. So if your AGI is $300,000, you're going to need more than, say, $22,500 in medical expenses before you can get the benefit. I know that sounds impossible, but when you add up your parents' costs, it might work. Let's just say mom is in assisted living. That's $5,000 a month or $60,000 a year. Now, not all that's deductible. Only the portion that's considered medical care. If she's chronically ill and requires substantial assistance with at least 2 activities of daily living, the facility should provide you with a statement breaking down her medical versus non-medical expenses. Typically, it's about 40 to 60% of the total costs. So let's just say $35,000 out of the $60,000 qualifies as medical. Add in her prescriptions, her Medicare premiums, her copays. You're at $45,000 in qualifying medical expenses. You clear the 7.5% threshold. And now you're deducting $22,500. At the 32% tax bracket, that's a $7,200 tax savings, but only if you document it correctly. Here's what I need you to do in the next 10 weeks. First, get a certification from a licensed healthcare practitioner stating that she's chronically ill. This means she requires substantial assistance with at least 2 activities of daily living, things like bathing, dressing, eating, toileting, transferring, or continence, and that this condition is expected to last at least 90 days. It's the IRS standard for qualifying for long-term care. Second, get a statement from the assisted living facility breaking down the medical versus non-medical portion of her costs. Third, gather up every receipt, every invoice, every prescription, every medical bill from 2025. Fourth, make sure you're providing more than 50% of her support. Add up everything: housing, food, medical, transportation, everything. Now, if your siblings are splitting the cost and there's no single person providing more than 50%, you can still use a multiple support agreement. The person claims the dependent, the others sign the form agreeing not to claim. Here's the kicker though. If you're using a health savings account to pay for your own medical expenses, you can't deduct those on a Schedule A. But your parents' expenses? Those are fair game as long as you're claiming them as a dependent. This is the kind of thing that gets missed every single year because people don't think of caregiving as a tax strategy. But it is. And if you're already paying for care, you might as well get the deduction. You've got 10 weeks to gather your documentation together. The third mistake is the one that catches people completely off guard. And it's probably sitting in your mailbox right now. You probably didn't sell anything, you didn't make any trades, but your mutual funds did. And at the end of 2025, they distributed capital gains to you. And now you owe taxes on those gains you never realized. This is called a capital gains distribution, and it's one of the most frustrating parts of owning mutual funds in a taxable account. The fund manager sells stocks inside the funds, realizes gains, and passes those gains on to you. You get a 1099 in January, and you owe taxes on money you never touched. I've seen this cost families $5,000, $10,000 in unexpected taxes, especially in years when the market is strong and fund managers are rebalancing a lot. So, what do? First, check your brokerage statements from December. Look for any capital gains distributions. If you see them, you need to plan for the tax hit now, not in April. Now, for 2025, the deadline to offset those gains with charitable donations has already passed, and that was December 31st. But here's what you need to do for next year, because this will most likely happen again in December of 26. If you're charitably inclined and you hold appreciated stock, donating the shares directly to the charity is far more tax efficient than selling and donating the cash. Let's just say you have $10,000 in a mutual fund that's appreciated to $15,000. You've held it for more than a year. If you donate the shares directly to a qualified charity, you get a deduction for the full $15,000 fair market value, and you avoid the capital gains tax entirely. Now, there are limits. Donations of appreciated stock are capped at 30% of your adjusted gross income. So if your AGI is $100,000, you can deduct up to $30,000 in appreciated stock donations in a given year. Now, also, any excess carries forward for up to 5 years. And if the donation exceeds $5,000, you'll need a qualified appraisal on it. So, when December 26 rolls around and you get another capital gains distribution, you'll know exactly what to do before December 31st. Now, if you're over the age of 70 and a half and you have an IRA, there's one strategy you can still use for 2025. It's a qualified charitable distribution. This is where you can donate up to $105,000 directly from your IRA to the charity. It never shows up as taxable income, and it counts towards your RMD if you're over 73. It's often better than taking the distribution, paying the tax on it, and then donating the cash. And if you're in the first year for RMDs, you may have up until April 1st of 2026 to complete the QCD and have it count towards 2025. Be sure to check with your custodian first on their deadlines for those types of transactions. Number 3, consider switching from mutual funds to ETFs in your taxable accounts. ETFs are structured differently, and they rarely distribute capital gains. You'll still owe taxes when you sell, but you can control that timing. And that's a huge advantage. Just be careful if you sell a fund at a loss and buy a similar ETF within 30 days. You could trigger the wash sale rule and lose the tax benefit of the loss. You could wait 31 days and buy something that's not substantially identical. But for 2025, the damage from capital gains is pretty much done. The question for you is, what are you going to do to avoid this happening again in 2026? Okay, here's reality, folks. You've got 10 weeks before April 15th. And in those 10 weeks, you can still make moves that will save you thousands of dollars. So here's what I want you to do right now. First, pull your December 2025 pay stubs and brokerage statements. Look for bonuses, capital gains distributions, any other income that hit late in the year. This is your baseline. Second, calculate whether you provided more than 50% support for your parents in 2025. If you did, get your documentation that you need to claim them as dependents. If you're not 100% sure, run the numbers anyway, it's worth it. Third, review your investment accounts. If you saw any capital gains distributions in December, note the amount so you can plan your estimated tax payments. And if you're over 70 and a half with an IRA, consider whether a qualified charitable distribution makes sense before your RMD deadline. Fourth, be sure to max out your IRA contributions before the deadline. If you're under 50 at $7,000, If you're over 50, it's $8,000. And if you're married, it's 16. These aren't complicated moves, but they require intention. They require you to act now, not in March when your CPA is already swamped. Hey, I know you're busy. You're managing a career, aging parents, kids, and everything in between. The last thing you want to think about is tax planning in January. But here's the truth. The families who win at this game are the ones who treat tax planning like a business decision, not a compliance exercise. They don't wait for their CPA to tell them what happened. They make proactive moves in Q1 so that by the time April 15th rolls around, they're in control. The families who lose, they're the ones who assume everything is fine until they get the bill. You don't have to be a tax expert. You just need to know what levers to pull and when to pull them, or somebody who does. And right now you have 10 weeks to pull them. Now, keep in mind these strategies are general guidelines and your specific situation may require a different approach. So be sure to work with your tax advisor to confirm your eligibility and timing. Now, if you're looking at this and thinking, I'm just not sure if these apply to me, I need help running these numbers, that's exactly what we do. We help families in the sandwich generation navigate these exact decisions every single day. The first thing to do is download the checklist. The link's in the description. Second, schedule a 15-minute strategy call with me using the link. It's down in the description as well. We'll look at your specific situation, figure out which moves to make that make sense for you, and make sure you're not leaving money on the table before April 15th. No pressure, no sales pitch. Just a conversation about what you can still control. Hey, if you found this helpful, make sure you grab the tax document checklist I mentioned earlier. It's in the description. It'll make sure you don't miss anything when you file. I'm Tim Gardner. Thanks for watching, and I'll see you in the next video.